Hey everybody, Brian Shannon here from alphatrends.net. It is Friday, July 10th, 2015. Let's take a look at this market. We had a very volatile market obviously this week, and the S&P 500 actually finished with a gain of 0.06%. We were down year to date before today's comeback of 1.3%, but as we'll see, we're not out of the woods yet in this market. Nasdaq lost a little bit of ground, no doubt dragged down by those semiconductors, which continue to be the weaker group. Oil had a difficult week too, down 11% for the month right now, and 6.5% for the week. And bonds, which are in a downtrend, continue to lose ground. So let's take a look actually first at oil. I just wanted to bring that up. I usually don't bring it up, and only if it's becoming more a topic of conversation again. And we had seen this big bounce after getting oversold here, and it got back above the 50-day moving average. That 50-day moving average was advancing, and then it started to flatten out. We lost support over here and came down almost to a two-thirds retracement. So it seems like this should be an area between the 50 and the 61.8% retracement where oil stabilizes. But again, we are below declining 50-day moving average there, and that means that oil is guilty till proven innocent. So let's look at the S&P 500. Here's a year-to-date chart, and on there, this dotted line is the year-to-date volume-weighted average price. So you can see that we did close just below it. On Wednesday, I think it was, I had tweeted that oftentimes when we see a move just slightly below a prior low after being oversold, it's a good place for a bounce. Now, it did bounce nicely from there. I think it was about 205 where I tweeted that, but obviously there was a lot of volatility in there, and to me, it didn't make sense to buy in that level and to be able to continue to hold. In fact, in Alpha Trends, what we had done that day is to purchase it at 205.55, and we got out by the end of the day simply because we still have this declining 5-day moving average, or we had at that point, and it didn't make sense to hold, especially when the market was coming back up to this prior level of support. So, we ended the week on a positive note. However, we are right up against this prior band of support, which has the potential to continue to act as resistance. So, I think that for next week, if we see a pullback down towards the midpoint of this recent range, down near about 206, 206 and a quarter, that would be the ideal place for it to hold, and then maybe regain some steam and be able to break higher once again. But when we look at it, as I pointed out on a chart today, we've kind of been trading in this range here for the last 6 months or so. And if this range breaks, then what's the next level below it? It seems likely that it would come down. Well, maybe I guess first to this point here, which was the third quarter highs from last year, just above 200. So there's still a lot of danger in this market. It is improving, but it's not worth holding, I don't think, for fresh purchases until it can get back above and hold above about 208 and a half. If it can do that, then perhaps the tide is turning back up again. But when we look at the daily time frame, you see we've got a declining 10, 20, and 50-day moving average, and those are typically not the times that a strong uptrend commences from. And of course, we've got that 200-day moving average, which was tested this week too. So things are very unclear still going into next week. For today's action, it was pretty interesting that I teach that class, which is going to start again next Friday. And one of the slides in there is that when the market is below a declining 5-day moving average and we get back above it, what often happens is that we see that gap up, the stock or the market dips below the volume weighted average price and regains it, and that's a good purchase place with a stop below here. Midday, we often see a slight pullback, and then it continues to close near the highs. So for today, we gapped up and we pulled back in here. So here's our, just to frame it, we gapped up, we pulled back and got back above that volume weighted average price. Midday, we had the shakeout just below that volume weighted average price, and it didn't close right near the highs, but it was still a very good game plan for the day. And now that we're back to the top end of that range, it was meant only as a day trade. So anyways, day trading, of course, is not for everyone, but it's a good skill to have when we have markets as volatile as what we're seeing right now and all this global uncertainty. The shares of the Nasdaq came down to their lows from April as well and held in there for now. It seems likely that at some point we'll get a test of the 200-day moving average and perhaps these lows from March and April in the excuse me, in the Nasdaq 100. Looking at a 65-minute chart, you can see here that we've got this prior band of support that's so far acting as resistance. We had a pretty big move up to that level, so the breakouts typically don't occur after a short-term extended move. So to me, it doesn't make sense holding into the weekend. But if we pull back and hold above 106.50 to 107 next week, then perhaps we can come back up towards the top end of this range once again, and above 108 and a quarter. If it can get above there and hold above there, then it looks good for the possibility of continued upside with a stop most likely down at about 107 and a half. But again, here we've got the declining 10, 20, and 50-day moving average, and that's telling us there's a lot of indecision in this market. It can recover from here, but so far it's neutral at best on the intermediate term time frame, so no real compelling reason to be an owner. And same goes true for the Russell 2000. We saw a couple weeks ago that from that failed move came this fast move lower, and we've been talking about guilty till proven innocent the last couple weeks while it's been below that declining 5-day moving average. You didn't need to read the news to understand that it didn't make sense to buy any of these equity indexes while we're below a declining 5-day moving average. So the news is often noise and distracts people from objective listening to the message of the market. But the objective message here for now is that we're up against a prior little level of support here. If we're to back down towards 123, same kind of scenario. I wouldn't want to buy up in here, but if it can pull back and begin to show some strength, then perhaps it's a good candidate for some upside next week. But again, it's a difficult trade here with a declining 10, 20, and 50-day moving average. Semis, as we know, got hurt the worst. They were down, what did I say, about 3% for the week. So semiconductors were down 4% for the week. That brings them down 3% year to date now. And here's another group that, from this failed breakout over here, this breakout was nice, but it failed, and then we've seen a larger move lower. We took a look a couple weeks ago at the measured move objective that got us down towards about this level, and it did not show any signs of stability there. Instead, we've been seeing more continuation, that is, of lower highs and lower lows below a declining 5-day moving average. It makes no sense to be a purchaser while it's below there, and this momentum is coming out of the market. So we came down and tested the lows for the year actually in the semiconductors, and that's the year-to-date chart. If we take a look at a longer term, you can see here that this has been an important level, and if we continue down a little bit lower, ideally this would hold as support and serve as a point to bounce from. However, again, there is zero evidence that buyers are gaining control. I think that up to about 54, 54 and a half, it's really just more of a neutralization process, that if it can get up towards there, pull back and then break out, then perhaps it's a purchase on that breakout with a stop underneath whatever this higher low would be, right around in this general area. But still, it's an avoid at best. And the financials also had a difficult week. 2 weeks ago we broke an important level of support, 2480-ish to 2490, and we've remained trapped below there. We did see some recovery, which was nice, but again, we've got 2480 to 2490 as the bigger potential level of resistance. So if we get up towards that, I wouldn't be excited. I would say that it would be better to see it get back up towards there, pull back, and then move higher, and to purchase at this point with a stop under here. We don't want to chase after we've seen these rallies over the last couple days. Defense wins the championships, as they say. Apple, I've been talking about. There's been no reason to be a buyer of this stock. We looked at it a couple weeks ago, and it was looking like an entry right in here. I had gotten involved on that day and stopped out over here, and it's been lower highs and lower lows below a declining 5-day moving average. So again, if you're a day trader, there's been some good opportunity. If you bought into the panic, the problem there is this the panic where you buy buy is this or this, or whatever your strategy is, do what feels right for you. But Apple is a damaged stock. We've got all this prior support up in here that has the potential to become resistance, and I just don't see any real compelling reason to be an owner of Apple, other than, of course, if you hold it at much lower prices and are managing a position. Bonds did what they're supposed to do in a downtrend, and another great example of the direction of the 50-day moving average. I saw people getting excited because the bonds were above the 50-day moving average, but more importantly is the direction of the 50-day moving average was lower, and rallies that develop with a declining 50-day moving average have a strong likelihood of failure. And that's exactly what they did do. They failed, and the downtrend in the bonds continues. So the market is telling us one thing about interest rates, and then you've got someone talking on television that tells us something else. Listen to the message of the market. The market is more important. The same person that talks about bonds is the same person that spoke back here about biotechs being overvalued and that they were due for a correction or cooling off. And the biotechs have soared and they continue to hold up very well. In fact, next week back above 375, 376, it looks like they have the potential to continue higher. So we're holding the 50-day moving average. I think breaking 360 would be an issue for this group, but they've still got great relative strength in the biotech group. And then if we take a look at some individual names, such as, here's what I would suggest you do this weekend. And when you're looking at these markets, they're obviously very extended, and they've been extended for a while, but we're starting to see that the dynamics are shifting a little bit, and we see stocks like General Motors declining and not being able to get back up. Green Mountain Coffee Roasters. These are stocks, start to study the way they break down and the direction of these longer term moving averages to realize what can happen when these stocks get hit. For instance, when Rackspace gets hit on a gap and just continues to bleed off, there's no value in a stock that's going lower as far as a purchase. It doesn't mean there's no value in it, but there's, people will say, oh, it's a deal because it's down 20%. It's not a deal, not when the momentum is lower. We look at Walmart. Walmart's had an awful year, and they, completely failed. This breakout failed, and it's been declining. Same with Western Digital. We spoke about that a couple weeks ago. Now it looks very similar to the way Johnson & Johnson is setting up. A longer term investor, I'd be very careful in here. Next week we begin earnings season in earnest, so always be aware of when the company is due to report earnings if you're going to hold it. That's another strategy we talk about. We talk about the news in the trading class. So I'm pitching you on that a little bit. It's a great deal. I really believe that. $397 for 10 plus hours of instruction that's recorded, plus 3 1-hour sessions, quizzes, and then a free month to Alpha Trends Gold, which includes the live trading room each and every day. Hewlett Packard is a stock that maybe you want to keep an eye on as far as potential downside. It's the weekly chart. We've got this head and shoulders pattern. It's broken that neckline, and it's starting to show a little bit of a bearish flag. So keep an eye on that one. These are the stocks we'll be watching in Alpha Trends as well. FireEye came down to the rising 50-day moving average and prior resistance as well. FireEye on a 30-minute time frame is starting to show signs that the buyers are regaining control. The ideal scenario in here would be a slight pullback and then to buy some strength, but the buyers are back in control, and then you have to decide what time frame you engage the market. And number one job is manage risk. Facebook looks like it's ready to break out once again here. We've got a little bit of a band of resistance in there, maybe a slight pullback, and then it goes. I would say keep an eye on eBay as well. eBay on the daily time frame and weekly time frame, we broke that bigger resistance. It holds up very well, and then the garbage continues to be garbage. Alibaba, people fight it, but I had people arguing with me, if you recall, that I pointed out the volume weighted average price since the IPO was here, and to be very careful about chasing it. The stock came down to new all-time lows this week, and you can say, well, it was only because of China, but this market, Alibaba has been a piece of garbage all year, whereas the Chinese equity market is up 60-70%. So and again, back to that FXI, I just don't get how or why people trade this. I mean, I guess I know why. It's why they trade anything. But to manage risk in something that gaps like this every single day is certainly not a strategy that I think is low risk. But again, do what you feel is right for you. Hope you have a good weekend, and I'll talk to you next week. Thanks.